Test. Well, hello, ladies and gentlemen. Good afternoon. An exciting afternoon to bring you 4 highly effective indicators every trader should know. We're going to be switching back and forth. So every once in a while you'll see my face, and then every once in a while we'll go to the screen, of course. We are doing an exciting presentation today, one that's had a lot of traction before, and it's really getting you comfortable with 4 highly effective indicators. And the reason why we want to introduce these to you are for a myriad of reasons. These are really the foundations of trading from the charts. And we wanted this to be as interactive as possible. I promise you, there is so much information here that you're going to have questions. So I do ask a few things as we're getting up and running. In fact, let me go ahead and put up this slide. The purpose here is so that you know what's coming up, because again, it's an action-packed time. What I'd like to do is just kind of go over some ground rules. You'll see here we're going to be talking about 4 highly effective indicators, and you see that I must state up front, because as a trader myself, there is no holy grail system. It really is based on how you are using the indicators in a way that's comfortable for you. When asking a question, again, there will be questions. Please put in #Forex in the question. That'll help make sure that we're able to really sift through the comments, because we always get a ton of comments during this time. So with that, if you can please put #Forex in the question, that's going to help us out a ton, making sure we can answer your questions. Also, if you like this presentation, this is just the snowball getting started down the hill. So please add us to your Forex circle and +1 this page. As we join in this venture of Google+, we want to make sure that you're enjoying the content that we're putting out, that we're helping you achieve your trading goals. So it's important for us that we're in your Forex circle, that the information we're putting out there that we always feel is of value to you is being communicated to you. So going back to the presentation, these are just the quick ground rules. Again, there is no holy grail system. I say win percentages and all it's cracked up to be. I'll kind of give you some back-tested results as far as from what I've seen from some of these indicators and tell you how to improve that. But really what's important is how you trade it. And what I mean by that is trading it in a way that's comfortable for you. You see below the question part, where again I ask you to type in #Forex when asking a question. Good is more attainable than perfect, and we want to look at that because by definition, if we're getting the quote unquote perfect price, that would entail us buying the bottom tick or selling short the ultimate market high, which isn't going to happen. It's the equivalent of hitting a hole-in-one in golf, not something you should attain to. So we're going to look at appropriate setups with these 4 indicators. And again, hopefully what you'll be doing is adding us to your Forex circle on Google+. And then what I want to do is I'm going to show you these indicators on multiple time frames. And there's really 2 types of indicators that we're going to focus on today. And what I'd like you to do is find a time frame that works for you. And we'll talk about that as well. Okay, before we get off and running, again, I would like to just do a quick audio check. So if you guys can hear me, if anybody can hear me, just please type in with the comments that everything is coming through clearly, because again, this is an audio-based presentation. So as that's coming through, let's go ahead and get started with really the meat of the presentation. Okay, so you'll see here, we have 2 types of indicators that we're looking at, both trend following and mean reversion. So when we look at trend following and mean reversion, there's actually 2 types of markets. There's a market, i.e. trending, in which we're hitting higher highs, higher lows, higher highs, higher lows. We've been seeing that with the Japanese yen crosses of late. So naturally there's indicators that work very well in a trending environment. Those indicators are moving averages, MACD. And again, the reason why those indicators work is because when prices break out and hitting those newer highs, we want to find indicators that A, help us recognize the trend, and then B, help us find a good time to enter the trend. The other type of market environment, I call it reversion to the mean, or essentially a range-bound market. Essentially, we have a very well-defined ceiling of price. We also call that resistance. We also have a very well-defined floor of price or support, and we want to be able to trade through there. So the 2 indicators we're going to look at with that is the relative strength index, also known as the RSI, and slow stochastics. And I'm going to show you how they work, and then also, importantly, I'm going to show you different ways that you can use them, because what's nice about trading with these indicators is that what really works well for one trader may not work for another, and how one trader reads an indicator may be read differently from another. So I want to show you the 2 type of market environments we see most often, and then the indicators that work well with those. And again, we're going for good, not perfect. And I state that again just because you can drive yourself mad, ladies and gentlemen, if you're always going for that perfect price, because like I said, the best golfers in the world don't always go for the hole-in-one. They're happy with par. They want to look for those high probability setups, and that's really what we're doing here with these highly effective indicators. Okay. So here's a quick point here that I like to share, one of my favorite quotes from Sun Tzu, but he just talks about how the general who wins a battle makes a lot of calculations beforehand. That the general, he or she, understands what's ahead of them before they get in. If you want to take this to trading, which we are, they get into the calculations and understand the different potentials before getting into the trade. And the quote, the general who commonly loses the battle does very few, if any, calculations. So naturally, there's multiple calculations when trading. There's entries and exits, which the indicators are going to really help you with that. That's the whole purpose there of having indicators to guide you when trading. And then also there's money management. How much do I risk on this trade? How much do I look to make on this trade? And I'll touch a little bit on that at the end, because no lesson on using indicators is fulfilled without money management. Okay, so we're going to go ahead, switch back. We're going to go ahead and dive in. I'm going to show you the 4 indicators that we're looking at today and multiple ways to use them. And again, if you have questions as we go through these slides, #Forex in the comments section. We'll make sure to answer those in real time. Another thing, actually, let me do this. I want to make sure that my charts are coming up as well. So you see, I'm going to be moving back and forth. In fact, let me pull that up. I'm going to be moving back and forth between real-time charts and the presentation. The reason why is because I want this to be dynamic. I want you to see real trades that are on right now, what real charts look like, because the presentation slides naturally they're static. They're not moving, whereas we have these real-time slides. And I'm excited about this because we're doing this presentation right before the FOMC announcement, which means that we're probably going to see some action that these indicators help us see. So here is the first real-time chart. In fact, I'm going to go back to the presentation and then come back to the real-time chart. You see here are moving averages, and it's the first combination we're looking at, a combination of a 50-day moving average and a 200-day moving average. So let's go back to the presentation. So when using moving averages, really they're best in a trending environment, because if we're looking at the other type of market we talked about, range bound, then essentially the moving average will be roughly flat. It'll be cutting price down the middle, and there's no real clear signal there. And really the beauty of trading and using multiple indicators and having different currency pairs that you can trade, the beauty there is that you can cherry pick. You can cherry pick the indicators you're most comfortable with, the time frame you're most comfortable with, and the currency pairs that move in a way that you can control well. In my experience, years of trading, I've seen that traders who get in trouble take on either trades with a trade size they're not comfortable with, they're using an indicator they're not really that comfortable with, or they're on a time frame they're not comfortable with. And there's trade-offs for everything you do. So it's important to get really in your comfort zone, so to speak, of trading. A great analogy I'd heard one time is that if you put somebody who is a world-class sprinter on the track, and then you put a couch potato right next to that sprinter, and you said, go, run. Well, it's not going to be a contest as to who wins the race, but really I think the question there is who's working harder. Well, the funny thing is the world-class sprinter, even though he or she demolishes the couch potato, gets further faster, he or she is actually working less hard than the couch potato. And the reason why I give that example, it's one I heard from Jack Schwager, who wrote a book called Market Wizards, but is that when you find the fit, which is going to be combined again with the indicator, the time frame, the currency pair that's comfortable for you, when you find that fit, you're going to realize you're not working as hard as you might have been when you were losing, because it was something that you were not accustomed to. So I want to state that up front. All right, let's go back to the slide. So here is moving averages. What we're looking at here is the ability to identify a trend, and then what's probably more important, find when is a good time to get into the trend. Because getting into a trend, in fact, let me make sure that that's up. Okay, we're back. Okay, so getting into a trend is great, but finding out when is key. And so what moving averages help us do is find dynamic, and by dynamic I mean acting, moving, breathing with the market, levels of support and resistance. So once we've identified the trend, in this case we have an uptrend, we then want to find places to enter. So the things that I'm going to look at, and you see here I have two moving averages. I have a 20-period moving average and a 50-period moving average. And simply what that is, it's what it sounds like. It's the close of the last 20 days, the summation of the close of the last 20 days divided by 20. That gives us the current 20-day moving average. The summation of closing price of the last 50 days divided by 50 gives us a 50-day moving average. As you can imagine, the longer the average that we're looking at, the slower it is to react. So some traders will put multiple moving averages. That's actually going to take me to my next slide, to help them avoid whipsaws. Essentially, what that means is that this indicator, it's lagging by nature, so you need to find ways to tighten that lagging up. So here are 3 ways you can trade moving averages. And like I said, this is going to be action-packed. There's a lot of information, so if you have any questions, #Forex. But again, we're just rolling through. So in my opinion, the easiest way to trade it is with multiple moving averages. I like to use any combination of a 20, a 50, a 100, or a 200. You don't have to use those, but it's the ones I'm most comfortable with. The 200 is used by everyone, it seems like, from hedge fund managers to newspaper writers to mom and pop investors. The 200-day moving average is the litmus test of whether we are in an uptrend, which would be shown by price above the 200 moving average, or a downtrend, price below the 200 moving average. Adding a what we call a faster moving average, just meaning that it reacts to price faster, which is looking over a shorter time. We get signals, and that's what we saw with that chart on the euro yen. And in fact, I'm going to go ahead and bring up my real-time chart. So you see here what I've done is I have highlighted 4 signals, 2 which didn't work out that great and 2 which worked out wonderfully. And really the whole idea here, going back to that idea of win percentage isn't all it's cracked up to be, I've seen traders with 75, 85% win rates, and they're still losing because they're losing more when they close out a trade at a loss than they're making when they close out a trade at a profit. In fact, one time we ran a study of over 12 million live trades. When we did this study of over 12 million live trades from September 2009 to October 2010, what we found is that on average, the biggest mistake traders made is that they were doing just that. They were closing out their losses at twice the pip amount than they're closing out their winners. So what we look at when we see a moving average system is that we want to have a profitable expectancy. And all that means is that if I'm right 50% of the time, I still want to make money. And the way I do that is by setting my profit target further away than I set my stop exit. It's as simple as what we like to call a 1 to 2 risk reward ratio. So if I'm looking to target 100 or 200 or 300 pips, well, then I'd want to have a stop exit of 50, 100, 150 respectively, so that again, if I'm right 50% of the time and at the end of the month I've placed 10 trades, I'm only right 5 times, and I'm still coming out ahead. That's key. Or, as I've seen with a lot of these moving average systems, the back test results are around 40% win rate. But that's okay, because let me go back to the screen. I see we've got a few questions here, so I definitely want to hit those in just a second. So here we have, and this goes back to 2010, so really we're looking at almost the last 3 years of price action on a daily chart with dollar yen. Now, one question we have is preference of moving averages, and what we mean by that is there's something called a simple moving average, which is the explanation I gave to you earlier. That just means if I'm taking the last 200 closes, adding them up, dividing by 200, that's a simple moving average. What an exponential moving average does, also known as an EMA, in regard to David's question, what's your preference, MVA, which is a simple moving average, or an exponential moving average. An exponential moving average gives exponentially, there's the word, more weight to the closing price, the recent closing price, than it does to the first price in the series. So if you're looking at a 20-period exponential moving average, the 20th price, the most recent price, gets exponentially more weight than the first price of that data series. So it's supposed to make it a little bit faster. In the end, I actually prefer the exponential just because it's a little bit faster, but in the end, I also feel that really the signals are not going to change too much. You just might get the exponential moving average, which we see here, a little bit closer to price than we would see on a simple moving average. So what I have here is an exponential moving average. I don't know if you can see here, but it's an EMA. Okay, and you'll see one thing I wrote here on the bottom is that we're looking at a combination of whipsaws and great trades. So the whipsaws, that's essentially here you get a trigger when price crosses above. I'm sorry, when the fast crosses above the slow, and you get in, but it doesn't go anywhere. Essentially, almost like a rubber band, and that's a concept I'll discuss a few times. You know, rubber band can only snap so far. What we're looking at here, we see a almost kind of that rubber band, and then it snaps back. So we get closed out, probably not much of a profit. Same thing over here. We go short, takes us out, not much of a profit. But the whole key here is that when you have a system, regardless of what it's based on, this is a very important concept. When you have a system that you're comfortable trading, you should take every signal. Why? Because you don't know what's going to be the big kahuna, so to speak. You don't know the one that's going to really make your month, make your year, whatever it may be. So here, over the last 3 years, and again, this is shown on a daily chart to give you a wider range, but this has 4 signals. Going back to the chart, we have a signal in 2010, which if I pull out the ruler tool on our trading station, before we're taken out of the trade, it's in the profit about 1,300 pips. Now, we essentially held on to that trade for almost 18 months. And again, this is just an example to show you how this system works. Here we have, it really wouldn't have been that good of a trade because you would have taken a loss, meaning that when the crossovers bounced back, it was about an 85 pip loss. When this one bounced back, it was about a 60 pip loss. So the idea here is to think big picture. What I mean by that is we had 1,300 pips here, and then now we're still in this trade after this crossover to the tune of about 1,800. Past performance, it's not indicative of future results, but the argument here is that when you have a system that you're comfortable trading, again, that's a key concept. You got to be comfortable trading it. Think about the world-class sprinter versus the couch potato. The winner is the one who's actually more comfortable in the act, and that's what I want you to find. So when you find the system you're comfortable trading, you can take every signal and trust the system. Okay, here are a few more ways to trade with moving averages that I wanted to share with you. We looked at a multiple moving average cross. Very popular one is the 50 and the 200. Again, what we're looking at is the 50 crossing above or crossing below the 200. When it crosses above the 200, it's known as a golden cross in trading. Essentially, it means that there's sunshine and lollipops ahead. It's a happy day. Death cross, 50 crossing below the 200. It's not even a happy sound. Death cross means that we're looking at a very sharp decline in prices. Next way, you'll see number 2, price crossing above. Excuse me, but price crossing above the moving average. That can be helpful to have a percentage filter, meaning that, and what I mean by that, I'm going to go back to the chart. Here, if somebody didn't want to use multiple moving averages, they could have essentially just had a filter. And I'm going to show you exactly how you can do that filter. There's something called a moving average envelope. And essentially what a moving average envelope does is you type in what you want the moving average to be. We're going to type in let's type in a 50. And we're going to say 1% of the currency pair. And this is just to draw an example. But so you see it's enveloping price. So if that's just one way you can do it. So if we have, excuse me, just want to make sure that's set up for you. So you see here we have the moving average. I put in the wrong moving average. We want a 50 moving average. So you see the envelope is around there, and you can do what you feel comfortable with. I see a lot of traders do 2% because, again, the whole purpose is to filter out unlikely moves. That's not going to affect it. So you would have gotten whipsawed here. Again, I feel like the beauty of the crossover is that it keeps you in more trades, but that's a crossover with a filter that you can use. And essentially, when I say crossover, when price crosses above, you want to buy, when price crosses below, you want to sell. The other thing you can look at, I'm going to take this off, is bounces. So here, I'm going to just show you a few. You have a bounce off of the moving averages. So that's another thing you can look at if you're looking to increase your trade size, or you see a runaway trend and you're not sure where to get in. Wait for price to come to a moving average, and if it bounces higher, it's a good day. All right, we're going to go to the next trend following indicator. And again, feel free to send in those questions, #Forex. We're going to look at the MACD. So the MACD stands for Moving Average Convergence Divergence. It's a commonly used indicator derived from an exponential moving average, which was asked earlier about which moving averages. And it's interesting in the sense that it helps traders identify changes in momentum and also helps you find trading opportunities around support and resistance. So really, the most simple way to explain it, and here's a chart with just a trading example. Really, the easiest way to use it is when the red line, which is the MACD line, and again, I do want to explain it again just because it's the first time you hear it, it sounds a little odd. It is a combination, essentially. The red line is the 12 and the 26 period moving average divided by 2. So essentially, it's giving you an average of 2 moving averages. And then the blue line is the signal line, and it really is the moving average, a 9-period exponential moving average of the red line. So naturally, it's not price-based 100% because it's a few ripples off of price, but it's meant to slow down the signals. And the trade-off there is you get less signals, but they're supposed to be a little bit more reliable. I want to show you a few ways you can trade with MACD and then go to the charts. So first way, the most common way, is to trade when the MACD line, which is the red line we just saw, crosses the signal line. Again, that's the two lines we're looking at there are the ones we were talking about. I'm not sure if you can see my arrow very well, but that's what we're looking at. The next thing is the MACD crossing above the 0 line. So what's nice about the 0 line is that it allows us to see an equilibrium point where we are essentially in an uptrend in the chart that you're comfortable with or in a downtrend. So when we cross below the 0 line, we have a sell signal. When we cross above the 0 line, we have a buy signal. On the divergence, when MACD is diverging from price, to me, that's one of my favorite signals. In fact, I have a few charts that I want to share with you on this. Okay. So here is a MACD chart. Naturally, I have a few for you. So when I say divergence, I mean that the MACD and the signal line are starting to make lower lows as price is making higher highs. Essentially, what that's telling us is that the force behind price is leaving. It's left the building. It's kind of like you're at that party that everybody's enjoying, and that one person who's really the life of the party leaves. The party starts to die. That's kind of the same idea when we see momentum divergence. Horrible analogy, I know, but that's the idea we're looking at here. So here is divergence of price, in which price is moving higher and MACD is moving lower. And essentially what happens is that the trend starts to fall off. The trend starts to weaken. Here we see the opposite, and this is on a dollar Swiss 4-hour chart. Price is moving lower. We start to see divergence, and then it pops up nicely. Now, the most interesting one to me is what we're seeing right now on the Dow, the US 30, which for traders outside of the United States, naturally you can trade CFDs with FXCM, which include S&P 500, the US 30, oil, gold, all of that good stuff. But here's what we're looking at. When we were feeling like it was the end of the world, I should say, in the fall of 2008, spring of 2009, price moved sharply lower as the MACD started to diverge. That naturally kicked off this current bull cycle that we're in now. Just a straight up run, it feels like. Any shakeouts have quickly moved back to the upside. Well, we're starting to see a very sharp move since last fall, and the MACD has started to diverge. I'm not telling you to sell. That's not the purpose of this. But when this does break, we could see a very sharp move. Just like we saw here, we could see an inverted version of this, meaning that once it starts to tick or once it hits that tipping point, it can get ugly. All right, Chad has a good question. He says, on the MVA cross, the simple moving average cross, how far do you set your take profit? Is it based on the near previous price activity? I don't like to set it on price activity, and I'll tell you why, Chad. It really is a personal opinion. Again, do what's comfortable for you. But what I like to do is use something called a trailing stop. So if we come here with a trailing stop, really what you're looking at is moving your stop below your trigger, which again, our trigger was the fast moving average, which I'm going to pull that back up. Now, this is the one we were looking at, was the 20 and the 50. So that's the golden cross we were talking about. But if you're using a different one, essentially the trigger was the fast crossing above the slow. So what we can do is we can move our stop, and this is where, to me, this is where that envelope comes in handy. Again, the whole purpose there is to help you avoid kind of what we're calling them whipsaws. But just because price breaks it doesn't mean it's a great place to be. So here you see we have the moving average envelope, 50 period, 1% on each side. So you see it came below it came right really to the envelope. Let me just zoom in there for everybody. So having a stop below the envelope, or it can be anything. Another tool you can use is something called a average true range, an ATR, and have that 1 times ATR. That's a fancy way of saying the amount in pips a currency normally moves on a day below the moving average, so that you have a filter. That's another thing you can do. So glad you asked the question, Chad, and I hope that helps. But essentially, I'm going to move the stop with the trigger plus a little bit of a filter. Unio has a good question about moving average crosses on a shorter term chart. So naturally, I've been teaching on a daily chart. I'm more comfortable teaching on a daily chart. But if we want to use a shorter, Unio wants to know what combination you use. I'm more than happy to tell you, and again, past performance is not indicative of future results. My first really successful trading strategy was on a 30-minute chart, and I had 3 moving averages. I had a 5, a 13, and a 62. And again, the whole thing is that I was looking for price to be above the 62, and then the 5 crossing above the 13 as my trigger. So essentially, the 62 moving average was acting as my trend filter. Am I bullish or am I bearish? The 5 and the 13 was my trigger. So those were faster, but a popular one is also going to be the 10 and the 30. That's another popular option. James Stanley has a strategy he calls the finger trap. He uses an 8 and a 34 on a 5-minute chart. Essentially, he looks at an hourly chart to find the overall trend, and then goes to a 5-minute chart to find crosses of the 34. So price, and that's what we talked about earlier, price crossing the moving average to get into the trade. So those are some common ones. Again, the big ones I use are the 20. I like to use the 20, the 50, the 100, and the 200, and those are big scale ones. Those work well on, I find, hourly charts or 4-hour charts or daily charts. When you get onto those smaller time frame charts, also known as scalping, then you can look at 10 and a 30, or again, I used a 5, 13, and 62. Those are some different options. Very good question. Okay, so we looked at MACD, and again, that kind of last thing I wanted to show you or leave you with was the current divergence we're seeing on the US 30, which is the Dow. All right, next, we want to start to look at those mean reversion type indicators. And again, we talked earlier about the fact that markets are either in 2 environments. They're either trending, and when they're trending, it's great to be trading a trending type indicator or following a trend. Big money is made there. But when markets are range bound, very well defined support and resistance, then we want to pull out a different tool from the box. You're not going to use a wrench to put in a nail. You're going to get out the hammer. So we want to find out what the market environment is. And again, we talked about moving averages have very distinct looks for a trend market or a range bound market. In a range bound market, a moving average really is just going to move sideways or not going to have much directional flow. Whereas in a trend bound market, moving average is going to have a very defined slope to it, as we saw on that Japanese yen chart against the US dollar. So next we want to look at is the RSI, Relative Strength Index. So this to me is a great tool that I hope everybody becomes familiar with. And specifically, what I want to show you are the new ways that we use RSI. And when I say new ways, I really just mean unconventional, maybe ways that you're not fully comfortable or familiar with yet. If you're not comfortable but you want to try it out, don't do it on a live account. We have demo accounts for that. You can just go to fxcm.com, try it, get a trial account, and test out these here. So here's just a quick example of the RSI, Relative Strength Index. What's neat about this, and in my opinion, very dynamic indicator, is that it can be used in multiple market. It can be used, here it is in a range-bound market. What I mean by this is that we had, this is pound dollar, excuse me. So we had this very well-defined range since the beginning of 2012. I'm going to change the color here because I'm not a fan of that color. Okay, we have this very well-defined range. And again, when I say defined range, I mean a very clear ceiling. The ceiling here was around the 62.50 level, and this floor was in that 52.50 level. So really it was about 1,000 pip range from bottom to top. And we saw that hold for a little over a year. In fact, if we look at it, yeah, right at about a year, because we see the breakout of this in February, and it started in last January. But all that to say, what you can see here, and this is really what I want to highlight. We have price up here, we have the RSI down here. What we're looking at, I'm just going to type this in. We have an overbought range, meaning that price is likely to turn over. And we have an oversold range. And the again is that this works best in an environment with a very well-defined top and bottom. Now, for you short-term traders, there's actually a time of day that we see this happen very commonly, and that's known as the Asian trading session. When I say Asian trading session, it really is around, it's around 2 p.m. to 2 a.m. Eastern time. Essentially, it's the afternoon session of the U.S. Now, this afternoon, we actually have the FOMC announcement coming on in just a little bit, so we want to be wary of that. But essentially, the force of volume in trading markets that normally is there to push new highs or new lows that we see in the London session just isn't there during the Asian session. So you can use the RSI very successfully if you're a short-term trader in the afternoon. In fact, when we did that Traits of Successful Traders that I was talking about earlier, we found that that was the highest win percentage or the most successful time of day. So here's how you use it. And again, this is on the big scale. We see the tops, the 62.50, also correlated with overbought. So we have an overbought here, meaning that the RSI crossed above the 70 level, crossed above here, crossed above here. And essentially when it turns below that, so it goes, to that 65, 60 level, that's our sell signal. What's interesting is that we're starting to get close to that level now. So I'm not telling you to sell now. What I'm telling you to do is really kind of focus your eyesight when we get to this level to see if we hit another sharp turn down. You see on the reverse side, we had an oversold level here. Price bounced higher. This oversold did not work out, but you can tell on the chart that it's not near the bottom of the range. So that would have been a signal to buy down here. Naturally, we were below for a period of time, and then we broke higher. But I think the reason why you can nullify this as a signal is because where it was on the chart, really in the middle of the range. Now, here's another way to use RSI, and I'm excited to share this with you because a lot of traders just use overbought, oversold. But there's multiple things you can do with RSI. Yes, the 70-30 level is very helpful. And just so you know, if you find a well-defined trend, which really we had on the title slide of RSI, if you find a very well-defined uptrend, then you can look for oversold readings to enter into the uptrend. If you find a very well-defined downtrend, which is what I was showing earlier, in fact, let me just go ahead and pull that up. Here's a well-defined downtrend with pound dollar on a smaller term chart. So we look for oversold readings. See, this tipped us off at around 58. It ended up going down to 48. So this signal worked out very well. So to to echo Chad's question, he says, so you're talking about trading in a range. Are you suggesting using RSI in a trending market as well? You can use it in a trending market if you just love this indicator. I know some traders, some of our analysts, RSI, it's the only indicator they use because of how versatile it is. I feel that it's best in a range-bound market, that mean reversion that we're looking for. However, if you define a well and strong trend, like we saw here on the pound dollar, and just so you know what I'm looking at, this really is this section right here. Let me go ahead and close this off. This section right here is what we were looking at on a smaller time frame chart. I'm going to have to zoom out quite a bit for this. So this slide that I had here was right here, was this signal. So again, we see this trend start to develop. So anytime there's an overbought reading in a clear downtrend, because remember, we were looking at that range, which was 62.50 to 52.50. So we were looking to take it back down to 52.50. So this is just showing you good places to either increase your trade size, or if you're not on the trend, if you're not in this trade now, this can be a good place to enter in. Okay, so here are ways to trade the RSI. Again, there's the overbought, oversold. What I like to do, depending on the time frame I'm trading with, because I understand short-term traders like to find those best opportunities. So a short-term trader using maybe a 30-minute chart or an hourly chart, I like to use more defined extremes. What I mean by that is instead of the typical 70-30 extreme levels, I'd like to use 80-20. The other thing I want to introduce you to, down here you see I just have the really just the formula. If anybody's interested in it, there it is. If you're not interested in it, that's okay. But what I wanted to show you here on this chart is that you can draw trend lines of RSI, and it's interesting to see how price reacts to those trend lines. So obviously we had this sharp sell-off in gold a few weeks ago. Well, not only did you have the downtrend, which would have been picked up by other indicators, but again, if you're somebody who just uses RSI, trend lines on RSI can also be a very helpful way to use this indicator. So here you notice that the RSI bounced off the trend line here. That was before that precipitous drop, and then it came up, bounced again. So it's showing essentially kind of some relative support and resistance of the indicator. And I'm going to see if I can get a link out to you guys. It's an article I recently wrote on the multiple ways to use RSI. And what you're seeing here is a 14-period RSI. Wells Wilder, who created this indicator, that's what he created it with, so that's what I commonly use it for. I see other traders use it with a 9-period RSI. It's going to be a little bit faster. And again, there's always a trade-off. Know that. There's always a trade-off. The trade-off here is you're getting, with a slower RSI reading, typically you're getting more reliable but less signals, whereas a faster you're getting more but typically less reliable. So I wanted to show you this on the gold chart. So there I just write RSI trend lines can be helpful to find momentum, resistance, and support. So here you see resistance of this falling momentum. Okay, so last indicator we want to talk about is stochastics. Stochastics, an oscillator. What's helpful about stochastic for a lot of people that RSI doesn't have is multiple lines. So you see there we have another crossover system, which again is very helpful for a lot of traders. Here you see I have it with Aussie USD. And essentially we had another well-defined range. Again, that's that whole mean reversion that we're looking at. So if we don't have a well-defined trend, higher highs, higher lows, higher highs, higher lows, or a downtrend, lower lows, lower highs, lower lows, lower highs, we have a range. And in that case, we want to find those extreme levels on the indicator to enter off of. So let me pull up a couple of charts trading with the stochastic. And there's two types of stochastics. You'll notice there's a slow stochastic and a fast stochastic. I like the slow stochastic. Again, it's that whole idea of less signals but more reliable. Again, Think of the world-class sprinter versus the couch potato. Do what's easier for you. Okay, so here is a signal potentially forming on Aussie USD. We've seen kind of this little bit of an uptrend here. It's part of an overall range, which was on that title slide I showed you earlier. But you see that we have these, what looks like from this kind of pivot point. In fact, let me scroll out a little bit further. So this was kind of the pivot point earlier this year. We moved up higher very fast, and we've had this retracement. So I'm going to zoom in back here because we're starting to see, again, more of the higher highs, higher lows, higher highs, potentially higher low, not by much though. But what we look at here is a couple of things. Same idea we looked at with MACD is when there's a divergence of price and momentum. So that was a tip-off we had here, and that price pushed higher, but momentum started to wane. Remember that life of the party guy we talked about. When he or she leaves the party, other people start to leave as well, and that's kind of what we see here with momentum. But the other thing, naturally, the typical way to use this indicator is when we have these extremes. So when we have these extremes, that really means that selling pressure has started to run out of steam. When we see a cross down to this level, this extreme level, and it starts to move back up. So you see that a couple of times where we move well out of the oversold territory, we move higher. We touch that oversold territory, we move higher. And it looks like we're about to do that again. So stochastics can be very helpful. I think it's a good indicator because, again, it's very simple to read. Again, let me show you a couple of ways to trade it, and then I'm going to show you some real-time charts. So one of the most helpful examples of trading momentum that I've ever had. And again, momentum is extremely important, but the idea here is think about you have a baseball in your hand, you throw it up in the air. Well, depending on the force you throw it up with, it's going to travel at a certain velocity for a certain period of time, but then it's going to hit that moment, that stopping point or that tipping point, if you will, where it slows down and even, sits still for a split second, a fraction of a second, and then it starts to turn over. Gravity takes over. It starts to move back down. So that's really what I think stochastics can help you do, whether it's in a trending market or a range-bound market. I prefer to use this in a range-bound. Again, if you identified a trend, that's the indicator you want to use. Then if we're in an uptrend, we want to find an oversold reading to enter back in the direction of the trend. If we're in a downtrend, we want to find an overbought reading to enter back in the direction of the trend. But think about throwing a ball up in the air so that can kind of help you see when these turn over, what we're expecting the market to do. The signals here are very simple. When the slow %K line crosses the slow %D line, there's our signal. Earlier I mentioned that there's a fast stochastic and a slow stochastic. The slow stochastic really is, the lines are a 3-period moving average of the fast. So it's just slowed down a little bit to, again, not give you as many signals, but hopefully more reliable. It's charted like most other oscillators between 0 and 100. So signals are generated when lines cross in extreme territories, or if you see a bounce off support in the middle. Let me pull up the chart here. So here we have a stochastic on Aussie dollar, and this is another currency pair that not a lot of people trade, but I think it gives a lot of good signals. So here is a rising channel in Kiwi Swiss. So you see here, down below, we have stochastics, and we have this rising channel. Well, naturally, in this rising channel, we'd look to take profits near the top when we have a crossover, and it's crossing below. And we'd look to enter the trade down near the bottom of the channel when the stochastic is crossing above. Of course, you can sell short, but it's a rising channel, so I'm more comfortable buying at the bottom of the channel when we have one of these crossovers, like here. In fact, let me just box them out for you. That might be a little bit more helpful. That's not what I wanted to do. Okay. Didn't work. Okay. So all that to say, you can see where I'm pointing to, but when we're at the bottom of the channel and we have stochastics crossing higher, that's quote-unquote our meat and potatoes. That's what we want to look at. Naturally, again, the reason why I pull that up, this specific currency pair up, it's given good signals, and it looks like we might get another turnaround. What's nice about this channel is about 250 pips, 275 pips wide. So you could go for a profit target of 200 pips, risk 100 pips, and what's nice, if you caught this channel, the lowest it's gone below the channel is around 70 pips, so it gives you that kind of margin of safety that we look for. So those are the 4 indicators we're looking at. We're looking at moving averages, MACD, RSI, and stochastics. Again, if you have questions, just drop that hashtag Forex in there, and we'll answer it for you. We have a good question from Jeff on RSI. He says, RSI versus stochastic oscillator, which one is more reliable and for what time frames? Oh, that's $1 million question that I do not have an answer to. From some of the back testing I've seen, when I've seen RSI far outperform other oscillators is when it has a, and I don't mean to blow anybody's mind, but it has a trend filtering mechanism. What I mean by that is RSI combined with like a 200 period moving average. So, and we talked about this a little bit earlier, but the win percentage, and again, this is no guarantee of profits for anybody, but the win percentage was significantly higher if you're using, let's say, a 200 period RSI. I'm sorry, 200 period moving average, excuse me, 200 period moving average. So if price is above the 200 period moving average, then naturally we want to be looking for buy signals because we're in an uptrend. Best time to get into the trade is, you know, a dip in the uptrend. So we look for an oversold reading coming back above the 30 level. Let me pull up here. Okay, so, and this is kind of the reverse of it, but if we throw up a 200 period moving average, I already have that. Essentially what we'd be doing is when price is below the 200 period moving average, we're only taking overbought signals. So really we only had that one right here that touched. This one naturally did not work out because it was right around the turning point. But the highest win percentage, again, that I've seen was when you have a filter to use RSI. I honestly haven't seen it with stochastic, so I can't speak to that. But very, very good question, Jeff, and thank you for asking. Okay, so we've covered the indicators. Again, I mentioned this earlier. I don't think that telling you very effective indicators would be of much use without what I consider super traders. In short, super traders preserve their capital. I like to say trading capital is your ticket to the show. So that's something that I recommend you always focus on, and more importantly, focus on protecting. A lot of systems that I see trade will use a percent of their account equity as their stop loss measure. Maybe that's 2%, maybe that's 5%, but use a method that's comfortable for you. One of our great instructors here, James Stanley, says something that I love, and essentially just get into your mind that the next trade you're going to take is but one of 1,000 insignificant trades over your career. In short, one trade usually will not make your career, but one trade can sure end your career if you're not managing risk properly, which leads into the next point, that positive risk-reward ratio. Think of it this way. If we're in a trending environment, we're trading with a trend, then what we want to look at is entry near a trend line with our risk level below that trend line. We talked about that filter. Or if we're trading in a range, our risk point, our stop point outside of that range, so that the market has to fundamentally change. The question I ask myself is, where should the market not go if I'm right? And that's really the basics of money management and using a positive risk-reward ratio. Depending, and it's regardless of the market environment, because it works either way. Next question, or the next point is, you know, how many losing trades will make you rest? So if the indicator's just not working now, maybe it's just not the right market environment, give it a break, take a break yourself, and come back another day. And then know the news to manage your capital, which brings me to the Fed decision, which is imminent, as I'm told by CNBC, will be coming out any moment. So what I want to do is I want to share a few things with you. We have a few tools to help you really build in these concepts, these indicators. One, we have a course on Twitter. It's free. We'll go ahead and post the link for you if you'd like. But every Monday we do a video lesson on one of these indicators, and then Tuesday through Friday we do real-time examples. This week happens to be RSI. So that's one way that you can get comfortable with these indicators that we talked about today. Again, it's free. You do what you want with it. If you feel it'll help you, please join. This is really the structure for it. We have we just started a couple months ago, but we have almost 4,000 followers, so it's been very popular. However, what I'm excited about introducing to you again, free. Please understand that. That's that's the banner that's behind me. Is that is the word free, but is the Daily FX Plus Technical Analyzer. And what it does, and you see here, I just took a screenshot of it, but it gives you signals, and it's just as simple as a red arrow for, you know, kind of a downward signal, or a green arrow for an upward signal. But all that to say, it's free for live clients. If you're not a live client, then we do offer a free trial, week. And you see here we have moving averages. And we have the 20 period moving average, 50 period moving average, and then across the 20 and 50, which to me is a very important signal. MACD, we have signal line crosses, which again is the red line crossing above the blue line, or vice versa. And then we have RSI extremes. Is it crossed down below 70, giving you a sell signal? Is it crossed above 30, giving you a buy signal, or vice versa? So this is a great way to have kind of a dashboard, so to speak, of these indicators we discussed. So that's it for me. I'm bringing you right up into the Fed decision. So if you have any questions, again, hashtag Forex. I hope this has been helpful to you. It's been helpful to thousands of other traders through articles we've written on this. In fact, we have an article that kind of introduces what we talked about today, so we'll have that posted as well. But if there's any questions, feel free to ask. Of course, what we'd love to see you do is add us to your Forex Circle +1 our page, and anytime we can provide something helpful for you, we want to be able to do that. All right, so it looks like we are nearing the end of this session, and again, we covered a lot. I just want to thank everybody who attended the room. I know we had a nice crowd, around 200, so I was glad to see that. Feel free to reach out to us on Google+. We're here for you and for your trading, and we'd like to do anything we can to help you reach your trading goals in a way that's comfortable and that works for you. So have a great day, and happy trading.